Looking for a safe investment in Poland with little risk? Let's talk about the Polish Treasury Bonds. In this video, we'll cover the pros and cons of these bonds, how they work, which bonds offer the best returns right now, and at the end, I will walk you through a full step-by-step purchase tutorial. Hey guys, if you're new here, I'm Piotr and I help foreigners and locals understand how to invest in Poland. Whether you are a Polish resident, an expat living here, or just a foreign investor considering investing in Poland, this guy is for you. And one more disclaimer, I am not a financial advisor and this is not investment recommendation. This video is for education purposes only. Okay, let's dive in. First, we need to understand what the government treasury bonds actually are. In the modern world, all national governments need money, whether it's to build roads, fund public healthcare, or support education. All of this costs a lot. Governments have two main ways to collect money. One, taxes, like income tax, VAT, or corporate tax. Two, by borrowing, when tax revenue isn't enough to cover all expenses. And here is where the government treasury bonds come in. When a government needs to borrow money, it issues bonds, which can be bought by individuals or institutions. By buying a bond, you are lending money to the government for a fixed period. In return, they promise to pay you regular interest and return your money when the bond matures. That is, when the time period ends. Think of it like this. Imagine your friend asks you to borrow $100 and says, I pay you back in a year, plus $5 for the favor. That's exactly how a bond works. Except in this case, your friend is the government. These days, nearly all Western governments spend more than they collect in taxes. So they issue new bonds every month to make up the difference. On paper, it might sound bad, but it's not always a negative thing. If a government borrows money to invest in things like education or healthcare, that can actually benefit the country in the long run. Educated and healthy citizens are more productive, earn higher incomes, and pay more taxes in the future, making the situation more sustainable over time. Can a government borrow unlimited money? Of course not. If a government spending gets out of control, investors may start to worry that it won't be able to repay its debt. When that happens, they become less willing to lend money, or they demand much higher interest rates. That's why government needs to be cautious about borrowing too much. The most common way to measure how much debt a country has is by looking at the general government debt as a percentage of GDP. This simply shows how big the country's debt is compared to the size of its economy. As of 2024, Poland's debt was about 55% of its GDP, which is considered relatively conservative and lower than the European Union average, which is 81%. Around the world, the biggest buyers of government bonds are usually banks and large financial institutions. That's also true in Poland. But what makes Polish treasury bonds unique is that individual investors can also buy them directly online, starting from as little as 100 zł. If you are a Polish resident or have a PESEL number, you can easily invest in Polish treasury bonds. Why do I really like these bonds? Because they are very safe investment, guaranteed by the Polish government. They offer better interest rates than typical bank deposits, and the inflation-adjusted options ensure that investors protect their money against inflation. Even for the long-term bonds, investors can redeem their money at any time for a small fee. What's important is that the fee can never be higher than the interest already earned, meaning that in practice, investors cannot lose money on this investment. Early redemption takes 5 business days, so if you decide to withdraw your money, for example, on Tuesday, you will get your money back Wednesday next week. Polish tax residents should keep in mind that income from these bonds is subject to standard 19% capital gains tax. The good news is that the tax on the interest you earn is deduced automatically, so you don't have to worry about calculating it yourself or reporting it separately in your annual tax return. Everything is handled for you. One more thing, if you don't want to pay this 19% tax, there is actually a way around this. You can invest through an IKE obligation account, which is a special retirement account where the tax doesn't apply. But IKE is a whole other story, so I'll cover it in the separated video. If you don't want to miss it, click that subscribe button. What are the cons of the Polish treasury bonds? For foreign investors, the main risk is a currency risk, as these bonds are issued only in the Polish zloty. While for people living in Poland it makes sense to keep part of their savings in local currency, investors living abroad face the additional risk that the zloty might lose value against the euro or the dollar. making the investment riskier for them than for locals. Are there any other risks? It is very unlikely that the Polish government would default on its debt, especially since the bonds are issued in local currency. Even in case of severe economic crisis, the government could simply print more money to cover its debts. Of course, this wouldn't be an ideal situation. Printing money would lead to high inflation, and investors could still lose purchasing power in real terms. Another, even less likely but possible risk is war. Recently, some Polish and European politicians have talked about the possibility of a future conflict with Russia. In case of war, the Polish government could temporarily freeze treasury bonds and block early redemption. Also, during the war, the government would almost certainly print massive amounts of money to fund military expenses, which would weaken the zloty a lot. In short, in the worst scenario, government bonds would become a very risky investment. What is my view on this? Right now, I don't see a major risk with the Polish Treasury Bonds, and I invest in them a portion of my paycheck every month. However, if the situation changes, if I see a real signs of a government default or a threat of the war, I'll be the first one to withdraw my money before things get ugly. What determines interest rates on these bonds? As mentioned earlier, when you lend money to the government, they pay you interest. But what actually determines the interest rate? The interest rate on government bonds is highly correlated with the central bank's interest rate. When the central bank, in this case National Bank of Poland, rises or lowers its rates, the interest on the new government bonds usually moves in the same direction. Why? Because the central bank sets the base cost of money in the economy. If inflation is high, the central bank raises rates to slow down spending and cool inflation. If the economy is weak or inflation is low, the central bank lowers rates to encourage borrowing and stimulate growth. Higher central bank rates also mean that bank savings accounts typically offer better interest. To stay attractive for investors, government bonds adjust their rates accordingly. In recent years, the economy in Poland was booming and inflation was high. Therefore, current National Bank of Poland interest rates are relatively high at 5.75%. If we look at current offer of Polish Treasury bonds, we see they offer similar interest rates to National Bank of Poland reference rate. On website obligacjeskarbowe.pl, you can check the current offer, which is being updated every month. There are 6 types of treasury bonds for regular people with lengths from 3 months to 10 years, but I think only the 3-year, 4-year and 10-year bonds are really worth checking out. There are also 2 special types of bonds for families with children. These give even better returns, and I talk about them later. Let's start with the 3-year fixed-term government bonds. Currently, they offer an annual interest rate of 5.75%. The interest is compounded annually. So if you invest 1,000 zloty, your investment will grow to 1,182 zloty after 3 years. After paying 19% tax, you will get 1,147 zloty in total at the end. But what if you want to withdraw your money earlier? If you redeem these bonds before the 3-year terms ends, there is a small fee. 1 zloty is taken from the interest of each bond. Each bond costs 100 zloty. For example, if an investor buys 10 bonds of a total of 1,000 zloty and decides to withdraw after 2 years, here's what happens. The earned interest after 2 years would be 118 PLN. The early redemption fee would be 10 zloty, 1 zloty per bond, leaving 108 zloty of interest. Then 19% tax is applied, which leaves a net gain of 87 zloty. In the end, you would get 1,087 zloty back after 2 years. Now let's move to 4 years inflation-adjusted bonds. In the first year of investment, they pay fixed 6.1% interest rate. From the second year onward, the interest is adjusted based on the inflation rate from the given month plus a fixed 1.5% margin. The key benefit of these bonds is that they help protect your investments from inflation. However, whether they will perform better than the 3-year fixed rate bonds depends on how inflation evolves over the next 4 years. And that's something we cannot predict with guarantee. So we can't give an exact final value of these bonds today. That said, the National Bank of Poland regularly publishes inflation forecast, which we can use to make a reasonable estimate. On this chart, you can see National Bank of Poland's inflation expectations for the next 3 years. The bold line shows the most likely inflation path according to the NBP, and we'll use those numbers in our example. If an investor buys a 4-year bond in May 2025, they will earn a 6.1% fixed interest in the first year. For the second year, the interest rate will depend on the inflation data published in April 2026 by GUS, the Polish Central Statistical Office. National Bank of Poland forecasts inflation at the time to be 3.8%, so the bond's interest rate for that year will be 5.3%. In April 2027, the expected inflation is 2.6%, resulting in 4.1% interest for the third year. National Bank of Poland hasn't published CPI forecast for 2028 yet, so we assume inflation will be in line with the central bank's long-term target of 2.5%, which gives a 4% interest rate for the final year. Using these assumptions, an investment of 1,000 zloty in May 2025 could earn about 197 zloty in interest over 4 years. After deducing the 19% tax, the total amount received at maturity would be 1,159 zloty. Now if you remember, the 3-year fixed-rate bonds offer nearly the same return, but in just 3 years. Why? Because based on current forecasts, inflation is expected to decline, so fixed-rate bonds are offering higher interest in next 3 years. It's also important to note that 3-year bonds compound interest annually, while 4-year bonds do not. For some investors, it might be a plus. They receive interest payouts to their bank account every year. But personally, I prefer compound interest because it automatically reinvests the earnings, leading to higher total returns. Let's also consider what happens if the investor decides to redeem the 4-year bonds early, after 3 years. In that case, the interest earned would be around 155 PLN. But there's a 2 zloty early withdrawal fee per bond, so for 10 bonds, the total fee would be 20 zloty. After paying the tax and the fee, the investor would be left with 1109, which is 38 less than they would get with the 3-year bonds in the same period. So based on current inflation expectation, 3-year bonds are likely to outperform 4-year bonds in the short term. Finally, let's take a look at the 10-year bonds. In the first year, they offer a fixed interest rate of 6.35%. After that, they work just like the 4-year bonds. The interest becomes inflation-linked, but with the higher 2% margin above the CPI, compared to 1.5% for the 4-year option. A key advantage of the 10-year bonds is that the interest is compounded each year, which helps boost return over time. As mentioned earlier, the National Bank of Poland doesn't provide CPI forecast beyond 3 years because inflation is very difficult to predict over such a long period. That's why 10-year bonds are a strong option for long-term investors who want to keep up with inflation. No matter if inflation is high or low, your returns will be always 2% higher than CPI. Since we can't accurately predict inflation over 10 years, I won't calculate the full potential return. But let's look at 2 shorter scenarios. If the investor buys the 10-year bond in May 2025 and decides to redeem it early, either after 3 years or 4 years. First, let's look after 3-year period. The accumulated interest will be 177 zloty, but after deducing 30 zloty withdrawal fee and 28 zloty tax, investor will be left with total net amount of 1119 zloty. This is 29 zloty less than the 3-year bond would have earned, but 9 zloty more than the return from a 4-year bond after the same 3-year period. Scenario number 2, early withdrawal after 4 years. Interesting thing happens if investor early redeems his money after 4 years of investing. The accumulated interest will be worth 230 zloty, and the total net amount after deducing 30 zloty fee and 38 tax will be 1162 zloty. This is 4 PLN more than a 4-year bond that has fully matured. So obviously, investor didn't need to pay early withdrawal fee. So how did the 10-year bond outperform the 4-year bond even with an early exit? Thanks to the higher 2% margin over inflation, and because the interest is automatically compounded each year, unlike the 4-year bond, which pays interest out annually. Of course, investors can manually reinvest the interest earned from 4-year bonds, but it's not very tax efficient. That's because they have to pay taxes on the interest every year. In contrast, with 10-year bonds, taxes are paid only at the end of the investment period. This means the full amount of interest can be reinvested along the way without any deductions from taxes in the meantime. Let's now briefly go over the remaining types of bonds. 3-month bonds can be skipped entirely. They offer only 3% annual interest rate, which is lower than most bank savings accounts. For this reason, they don't make much sense as an investment option. 1-year and 2-year bonds are somewhat unique, as they are tied to variable interest rates. In the first month, they offer a fixed return, 5.75% for the 1-year bond, 5.9% for the 2-year bond. After the first month, the 1-year bond pays interest based on the National Bank of Poland reference rate. The 2-year bond pays National Bank of Poland reference rate plus 0.15% margin. With the current National Bank of Poland reference rate at 5.75%, these bonds remained relatively attractive compared to 3-year bonds. However, in May 2025, the National Bank of Poland announced a 0.5% interest rate cut, which will reduce the yield on these bonds by 0.5% starting in June. The National Bank of Poland has also signaled the possibility of future rate cuts later this year and into next year, meaning the interest earned on these bonds will likely decrease over time. Another downside is that the interest is not compounded. Instead, it is paid monthly to your bank account, which again, I don't like. That said, 1- and 2-year bonds can still be a decent option for those seeking very short-term investment. One key advantage is the very low early withdrawal fee, 50 groszy for 1-year bond, 70 groszy for 2-year bonds. To sum it up, if you know you'll need the money in next few years, for example to pay a flat deposit, the 3-year bonds are likely your best choice. They offer the highest short-term returns and are straightforward. Plus, May 2025 might be the last chance to lock in a good 5.75% fixed rate for next 3 years. Starting in June 2025, the National Bank of Poland rate will fall down to 5.25%, which likely will also reduce future offering in government treasury bonds. 3-year bonds also protects you from possible future cuts in the coming years, which are likely to come. If you are investing with a long-term horizon, 10-year bonds are a strong option. They are designed to protect your money from inflation, offering returns that will be always 2% higher than inflation. Even if you are unsure how long you'll keep money invested, 10-year bonds might still be a good fit. If you end up needing to withdraw earlier, the returns are still quite solid, often better than 4-year bonds. And if you decide to hold them until maturity, you'll benefit from compounded interest and inflation protection, making them the most profitable option over time. Keep in mind, all examples I show here are based on the May 2025 bond offer. But now that you understand how this bond works, you'll be able to evaluate future offers on your own. You can always check the current bond offer at the website obligacjeskarbowe.pl/oferta. While the type of bonds rarely change, the interest rates and terms can vary, so before you invest, check the interest rate, which is always clearly shown on the website. Look at the early withdrawal fee, as this has changed in the past. For inflation-linked bonds, check the margin added to the CPI. Simply click Details next to the bond to see the exact percentage. Family bonds. As mentioned earlier, there are two special types of government bonds known as family bonds, available in 6-year and 12-year versions. They are called family bonds as only people who are beneficiaries of a government program Rodzina 800+, previously called Rodzina 500+, are entitled to buy these bonds. If you live abroad or don't have children, you can skip this part. But if you live in Poland, have children, and are part of the 800+ program, these bonds are definitely worth considering, as they offer even better returns than the standard bonds discussed earlier. Both 6 years and 12-year family bonds are inflation-linked. In the first year, the 6-year bond offers a 6.3% fixed annual return, and the 12-year bonds offer 6.6%. After the first year, the 6-year bond yields CPI plus 2% margin. The 12-year bonds yield CPI plus 2.5% margin. Both of them compound interest rates over bond duration, and the entire principal plus interest is paid out at maturity. Early withdrawal fee is 2 zł for 6-year bonds and 3 zł for 12-year bonds. As you can see, these bonds offer better rates than the previous bonds I was showing you. The only limitation is that you can invest only up to the total amount you've received through the Rodzina 800+ or 500+ program. For example, if you have one child and receive 12 monthly payments of 800 zł, your investment limit for that year is 9,600 zł. Also worth noting, your total limit accumulates based on the past payments received. Let's break it down with an example. In 2023, under Rodzina 500+, you received 6,000 zł. In 2024, under Rodzina 800+, you received 9,600 zł. By May 2025, you received an additional 4,000 zł. That means, as of May 2025, your total eligible investment limit would be 19,600 zł. So finally, how to buy those bonds? Bonds can be purchased on website obligacjeskarbowe.pl. But to have this possibility, investors need to have a bank account in one of the Polish banks, either PKO BP or PKO SA. Both banks are fine. However, if you want to buy family bonds, only PKO BP allows this. I personally use PKO BP as they have konto za zero, meaning I don't pay anything for this account. Both of those banks don't charge any commission for buying bonds. In my step-by-step tutorial, I show you how to buy bonds from a perspective of PKO BP account owner, but process should be similar in the second bank too. Once you open an account in PKO BP, you can head up to portal in which you can buy bonds. To do it, go to My Products, Investments, Treasury Bonds. After clicking Go, you will be taken into a website zakup.obligacjeskarbowe.pl. The website is unfortunately available only in Polish. To see your treasury account details, go to Rachunek rejestrowy, dane rachunku rejestrowego. What's important here is the account number of rachunek rejestrowy. It is your individual account number for treasury bonds. To buy bonds, first you need to transfer money into this account. You can do it from any of your bank accounts. I've already transferred 500 zł into this account, so this is visible now under Saldo gotówkowe. This is free cash I can use to buy bonds. Below you see the account number of your linked bank account. This is the account all of the earned interest will be paid to. Usually this is the bank account you've opened in either PKO BP or PKO SA banks. Once you have cash available on your rachunek rejestrowy, go to Zakup obligacji. Here you see all of the current bond offers. In this tutorial, I will buy 3-year bond. To do it, I click Wybierz. Now I enter how many bonds I want to buy. Remember that each bond costs 100 zł. Because I have 500 zł available, I enter 5 bonds. Automatically, it will show a total cost of 500 zł. Then you click Dalej. You see the summary here. To confirm, you click Zatwierdź dyspozycję. The execution might take up to 1 working day. However, usually it is much faster. After execution, you will get an email confirming your purchase. Later, you can head to stan rachunku rejestrowego to see all of the bonds you hold with dates when they mature. And that's it. So, did you buy those bonds? Look at you. Now you are officially a lender to the Polish government. Personally, I put a portion of my paycheck into 3-year and 10-year bonds. Let me know what you think about those bonds and if you have any further questions about them. And if you want to see how interest rates in Poland can affect other investments like stocks or houses, check out this video. That's it for today. Thanks for watching, and please let me know in the comments down below what kind of topics you would like to see on the channel next. I'm Piotr from MyInvest, and I see you in the next one.